Hello and welcome to Property Matters. I'm Stephen Galpin, and today we're going to be looking at the state of the property finance market. And to help us with this is Lucy Waters, MD of Aria Finance. Welcome, Lucy.
Hi, Stephen.
Good to have you back in the new year.
Yeah, thanks for having me.
Good. Well, I hope you got good news for us and not bad news. That's all I'm talking about today. Now, UK house prices softened towards the end of 2025. With a quoted 6% fall in 0.6% fall in December. On calculations, it looks like that the UK average property price is around 290,000. Do you go with that?
Yeah, I think the last Halifax data came out 297 there or thereabouts for December. So actually, the sort of overall picture isn't too gloomy in terms of house prices, but there's obviously some regional differences there, with London and the southeast suffering somewhat.
Yes.
Where obviously
I'm very nervous about taking a cross-country view on these things. I remember sort of back in COVID, there was a sort of rush to buy properties in the country with more garden space because people were restricted to home and all the rest of it. And we got all sorts of stats coming out sort of saying, oh, well, country homes, they've had a 400% increase in sales numbers this month. And you'd think, crikey, that's good. But actually what it meant is that they sold 4 properties instead of 1. You know, so it wasn't that meaningful. And although I get criticised sometimes for being a bit London-centric, I do believe that London sets the pace and it ripples out countrywide. Now, I don't know whether that applies to the finance market, does it?
I think, yeah, look, London it's always going to be a hub. And I think in terms of people making money in property, investing in property, London has always been a really safe place, or perceived to be a really safe place to park money. Obviously, with average property prices being considerably higher, yields have always struggled a little bit more in any case, because your yields are lower, and therefore when it comes to investment, that drives lower debt, and that couldn't be truer at the moment, with obviously interest rates having risen significantly over the last few years, and affordability pressures on those mortgages. Actually borrowing and investing, especially in buy-to-let assets in London, is a lot harder than it used to be. And then obviously from a homeowner perspective, you have the affordability pressures for people to be able to come up with a deposit and afford the monthly repayments and pass the lender's affordability test. So I think London has, whilst you see obviously higher wages and perhaps better affordability than you might see in regional areas, it's definitely struggled the most. And I think it's pulled down property prices because you see much better results coming out of some of the northern regions.
And why is that? Is it because commuting costs are so big now? Or?
I think that the whole way that people live and work has changed a little bit, for one. So you get a lot more working from home, although that tide definitely turned a bit and we've seen more of a move back to offices. I think there are still a lot of businesses that offer a degree of flexibility. So people who work in London don't necessarily have to live in London. And I think that has had a contribution. And we've talked about it actually on here before, with the Help to Buy leaving the market. That had a huge impact, especially on your kind of 2-bedroom flats in and around London. That definitely caused a slowdown.
But this work from home business, I mean, because it's perfectly obvious, but a lot of the big firms now, say here in Canary Wharf, for instance, are saying, hold on a minute, we're paying 5 or 10 million quid a year rent for this huge office block full of every facility that you can manage, and you want to sit at home and work at home? No, thank you. You're going to come back to the office.
Yeah, the tide's turned.
It has, hasn't it?
Yeah.
And I don't think that's a bad thing. I think it takes a really disciplined person to be able to get the best out of themselves working at home.
I agree with that. I think productivity goes down.
You've only got to have something good on the telly and you're gone, aren't you?
Yeah, look, I've always believed, and us as a business, we've always been office based entirely. And we noticed that a lot of the banks and the lenders that we work with that moved to home working, we really noticed that service suffered as a result of that. And I think that's true of all sectors.
You've got no interaction with your work colleagues, so if you have ideas or you have problems, you've got nobody to discuss them with, other than on a phone call, which is never the same.
Yeah, you don't learn in the same way.
I mean, if you talk to young people, they'll only ever text, and if you say, well, why don't you talk to me? They say, well, I did, I text you. But it's not the same. But it's not the same. You can't see the tears, you can't see the smiles, you can't see the thought, can you? It's a difficult subject. Okay, just coming back to London and this sort of softening of prices. I mean, I accept that in some regions of London, prices have dropped quite significantly, and 25 to 30% in some cases.
Prime postcodes, for sure.
Yeah. What's causing that softening of pricing?
I think there's a number of factors. So interest rates is an obvious one. I think there's also tax regimes and the perception of the UK as somewhere to invest, and how we attract foreign investment and foreign buyers. I think that was a large part of the prime market. The budget, obviously, last year was a real hindrance from the summer onwards, at the very least, because it was one of the most speculated budgets that I remember ever seeing. And I think that with the speculation specifically around the sort of higher value properties, that put a lot of people off transacting in that market in the run up to the budget, even though it was obviously nowhere near as bad as we anticipated.
Do you think the government understood that would be the reaction?
It's a really good question, Stephen, and it's hard to see how they wouldn't have understood that, because speculation is never any good for a market, especially when it's negative speculation. So it's hard to believe that they didn't see it, but perhaps they just needed more time to get their ducks in a row.
I think the question I would like to ask of number 10 is that with that budget, taking into account also the U-turns that have gone on since, and some of the catastrophic choices that were made, was it a budget that was created by number 10 and our Chancellor, so number 10 and number 11 working together or individually, whichever way they do it, or was it a budget that was inflicted on them by civil service advice?
Yeah.
It's an interesting thought, isn't it? Where did it come from?
Yeah, I think there was a lot of ideology in there, and there was a lot of, it was a very political and a very politically debated budget, wasn't it? There was this sense of, we heard it a lot in the news in the run up, the broader shoulders, and I think that really spooked specifically the London and the prime markets, where you would expect the broader shoulders to lie.
I mean, I was listening to the news today, and for instance, the government are apparently considering stopping or restricting the London Freedom Pass.
Right.
Now, what does that give you? It gives you, after the age of 66, free travel on the tubes, trains and buses in and around London. Okay. And apparently, within hours of announcing this thought process, they had a petition with 3 million signatures on it.
Wow.
And saying, look, you haven't thought this through, because you get up to the age of 60 to 66, you get a free Oyster card, which isn't chargeable. Then the Freedom Pass takes over as you head towards your 70s. And so what are you going to do? Give it to people free for 60 to 66 and then cut them off and create poverty amongst pensioners, or what? And communication, the government always go on and say, talk to your neighbour, travel, go and see your friends, go and do this. And that seems just the kind of thing that, again, they're sort of ignoring. And it just smacks to me as somebody in the Treasury saying, oh, listen, we could save 3 billion a year doing this, and let's do it.
Yeah, I think the thought process to certainly from the property side and from the earning side, to try and tax our way out of it rather than to invest in growth is a continued frustration. And we certainly see that in the property market with a lot of our developer clients who feel frustrated at all of the red tape and the inability to be able to cut through that. And every time that something positive is announced in order to try and achieve housing targets and what they may or may not do, something else comes in that creates another burden. And it's the whole lack of ability to be able to grow and improve the economy rather than just pay tax.
I think my comment when they announced the 1.5 million homes by the end of this parliament was, I think I said, good luck.
Yeah, I mean, we're abysmal at hitting housing targets in any case, but I think that was.
But there's a fundamental flaw there anyway, because even if you build this 1.5 million, whether it's to a housing association, whether it's to an individual client, whether it's to an investor, somebody's got to buy all these homes.
Yeah.
And somebody like you has got to provide the finance for them to do that. And I'm not sure you can.
Well, look, there's actually a real availability of mortgage products out there. And that's the funny thing. Mortgage lenders are there, they want to lend, but has to stack up. The affordability has to stack up. And at the moment where there's such a disconnect between house prices and affordability and deposit size and then your other costs such as stamp duty, it's really hard to make it work for people. And therefore the private rented sector is such an important part of our economy that actually on the other side we should be supporting that more and looking for ways to help to grow that side of the market if we can't encourage more home ownership.
But hold on, it's a little bit like the electric car syndrome, isn't it? They want to encourage electric cars, and what do? They cut the benefits.
Yeah.
It's just balmy to me. And I mean, as far as housing is concerned, if you're a young person trying to get on the ladder, as I've said to you previously, here in Canary Wharf, you've got one of the developments here starting one-bedroom flats at 880,000. Well, I don't know how a young person's ever going to afford that, even if they're a couple.
No, it's a lot of money, isn't it?
I mean, with a combined income, they're going to need 150,000 quid, aren't they?
Yeah, I mean, general rule of thumb, and obviously this is not binary because there's a more complex affordability calculation that lenders apply by looking at people's committed outgoings and their sort of discretionary expenditure. But as a general rule of thumb, you might say broadly 4 times an income would be required for mortgage affordability. Some lenders still have that in play and some of them work more on an affordability only. But if you say 4 times income on average, some will do slightly more and some will do slightly less. That just shows you really what you'd need to be earning in order to.
But let's just wind the clock back a little bit. I mean, I think at the height of it all, before we had the financial crash of 2008, 9 or 10, whichever bit you think was the catalyst, we were looking at sometimes 6 times earning, weren't we? And I have seen exceptional cases where it was 8 times.
Yeah, I was going to say, I think 6 actually was probably at the lower end in many cases.
And self-certification too.
Yeah, and look, that didn't work either. So I think that we needed to see a more prudent affordability regime come in, and I think that's probably served us well because we often hear the term stress test, and we've heard that a lot over the last number of years. And I think a lot of people that are borrowing see it as a hurdle to overcome, but actually the stress came, didn't it? We saw the stress in 2022 and 2023 when interest rates went through the roof. Yeah. And actually then people coming off of low fixed rates and their borrowing costs rising exponentially, actually the stress test that lenders put in place to make sure that they could afford that rise stopped us from then falling off of a cliff when it came to affordability at the end. So there's a balance for sure, Stephen, and I'm not sure that we've quite got the balance right at the moment. And I think the new interest rate environment will probably prompt a little bit of a reset on that, and that's happening. There's regulatory review on affordability, and lenders are looking at whether there should be certain stress tests and how how they look at things moving forward in a more normal or more usual interest rate environment.
Well, let me just comment. 100 years ago when I bought my first home, I think I paid about 9.5%, and I was always taught at that time that if your borrowing was at a rate of under 10%, you were doing okay.
You were lucky, yeah.
Yeah, and then of course it went up to 15% at one time, didn't it? But just coming on to the subject of mortgages for, and I don't mean this in a disrespectful way, but for ordinary people. And I say that, people with normal jobs, normal salary expectations, no super growth in their career path, just as normal. Do you think it's time that we looked at the way we provide house finance rather than this just either building society or bank provision? I mean, I'm thinking in terms of mortgages that perhaps stay with the house rather than the person, longer period of payback, maybe 50 years, and that could be passed down through generations. I just wonder whether it's time to have a rethink.
Yeah, well, there are economies which have longer term fixed rates, which is an interesting one, because I think if somebody was going to buy somewhere and it felt like it was their forever home and they fixed their mortgage for 20 years or 25 years and they knew that that was going to be the cost of their mortgage and that they had done their numbers on that appropriately and the bank had checked the affordability appropriately. Obviously things can change in the future, but that is, I suppose, one way of looking at it, whereas ours is a little bit more, we fix for 2 years, we fix for 5 years. Some people might take a variable rate, we move a lot. So our market doesn't really operate like that. A wholesale shake-up of mortgage finance, I mean, it's an interesting question, but I suppose you become quite embedded, don't you, in the way things work. And we always hear this word innovation and everyone's always talking about innovation, but it feels like innovation in the mortgage world for us has been really just tinkering around the edges as opposed to wholesale change.
Yes. You see, I'm thinking, I read some of your notes on the subject, and you are witnessing a return to a higher loan to value in terms of mortgages. We're looking at 90 or 95% mortgages again now, which I suppose is a step towards the 100%, isn't it? I'm not sure what my view of 100% mortgage is. I don't think anybody takes a mortgage out with the idea of defaulting on it. So I don't think it's quite as bad as some people would make out. But I do agree that it could cause young people stress if there is a sudden change in the market, whether it be interest rates, house prices, negative equity, or any of the taboo subjects that we get with property. So I don't know, but do you think it's a good thing?
Look, I think it serves a purpose, and I think that there are still some soft costs, and you have your stamp duty, your legal costs, valuation fees, moving costs, and if it's a first-time buyer, they have to set the house up with furniture, and there's costs associated with it that would not seem insignificant to that individual when buying their first home. The problem that you have with it is that some of the stress situations that you just listed, you then can end up in a situation where you create mortgage prisoners. So I think we would have to have the banks and building societies and non-bank lenders support to the market that they would continue to allow that loan to run, and if it reached expiry of, say, its initial fixed period, if it was a 2 year or 5 year fixed period, that they would allow that to run without a re-underwrite, which a lot of product transfers do allow for in the market, because that they want the client retention anyway. So if somebody's paying their mortgage, a customer that's already with them is valuable versus going out and having to acquire a new customer. So I think if they can transition people on, and you don't create a scenario where you have a mortgage prisoner that can't do anything, but if somebody then looks to sell and their property value has fallen, that's when you can cause the problem, because then it's a case of actually having to stump up the money.
But I think, if I remember rightly, I've got a feeling it was the 90s where banks and building societies were ordered to be more helpful to, shall we say, delinquent borrowers.
Right.
And I thought that was always a very good idea, rather than just leap for repossession.
Well, we saw it in COVID as well, didn't we?
Yeah. I mean, you know, people forget a bank don't want to repossess your property.
No.
The last thing they want is to have your property on their books.
It's also not very easy for a bank to repossess a property. It takes time, and you know, it's not easy on anybody involved.
No. Okay, let's just move on for the final minutes of our show to buy-to-let. Now, the government has been quite difficult with what they call accidental landlords, and I think what they mean is really the private landlord with 1, 2, 3, 4 properties. Now, they've had a bit of a holiday in terms of lending criteria. There have been specialist firms for buy-to-let who've been quite relaxed about the conditions. They base the lending on rental income rather than the person's finances, and I think that's a great thing, specialist lending. Because you do get professionals looking at what you're asking for. And I think that's absolutely great. But again, the government seemed to have jumped in and put a stop on all of that by encouraging the institutions to take over buy-to-let. And I'm not sure the institutions are going to be very much better at it than anybody else. Why? Because I think the private landlord is very conscious of his asset, tries very hard to get a good tenant, and tries very hard to look after them. I'm not sure that some of these big corporates will. And in fact, I think they'll be quite, don't know what the word is, but quite brutal when it comes to affordability and what they're going to get in terms of yield. How are you finding the financing for these sort of projects? Are the big institutions taking up the finance and individuals being left behind? Or
we're seeing a mix, actually. Now, I think when it comes to the smaller landlords, the sort of sub 3 properties, perhaps, if you were to use that as a cutoff, that market is really tough. So unless somebody has ambitions to scale, I think it's very difficult for people to transact in that market and make it work. So we've seen definitely a movement more towards higher yield assets, which is probably part of the London sort of regional divide. And people are much keener to seek better yields, either by moving further afield or, in areas that present stronger yields, or by changing the asset class slightly to HMO, co-living, student accommodation, and alternative types of assets. And co-living is something that we've actually seen quite a rise in recent times.
So you see that curtailing of the small private landlord is being converted into perhaps a restructuring of that kind of business, I suppose, then?
Yeah, to some extent. And I mean, we still deal with a lot of landlords that have, say, 3, 4 properties upwards to, many landlords that have 50, 60, 100 properties. And actually, I think the difference there is it becomes a bit more systemized. It tends to be somebody's full-time occupation as opposed to something that they're doing alongside their main occupation, and I think that makes a bit of a difference. And I think people,
I don't think that's a bad thing.
I don't think that's a bad thing either, because people can give it more time and attention. And in terms of mortgage availability, there is a lot out there. There's debt is not difficult to come by, provided the numbers work. And I think that's the key, really. It's about finding appropriate yields to support the debt in today's interest rate environment.
Okay. Lucy, I'm going to say thank you very much for coming in today. It's been great to have you in the studio. So that's Lucy Waters, MD of Aria Finance. Really big thank you.
Thank you for having me.
Thank you for the information that you've provided. We're now going to go over to Will Stevenson, co-founder of FiberPay, for this month's Industry Insights on Foreign Exchange. Will, welcome to our Industry Insights property programme. and our monthly look at the world of currency exchange. What have you got to tell us this month?
Beginning on the property market, I think 2026, we've already seen a fantastic start to the year. That uncertainty that we had from the late budget last year, now we know that the expectations of it causing a lot of havoc for this year, we know now it seems business as usual. So that's, of course, fantastic. In terms of the currency exchange markets, I think one big factor to look out for this year is interest rates. Of course, we've had an interest rate cut towards the end of last year, and it seems that the Bank of England is talking about further cuts throughout the year. Now, that technically should devalue a currency. However, actually the complete opposite. Ever since COVID, we've seen a complete flip in trends in the markets, and actually we could see the currency go the other way. I believe that it's still going to attract overseas buyers. The pound is probably a little bit undervalued at the moment, and looking at other jurisdictions and their interest rates, Europe currently being lower, I think it's still really appealing for Europeans to of course transfer funds and purchase in the UK.
The standard comparison is obviously with the dollar.
Yes.
I mean, how's that going? Some reports you read that Trump is absolutely decimating the American market, so therefore the dollar should be cheap, but it's not.
It's not. The dollar is the world's safe haven currency. So whenever we see huge geopolitical problems like as we're seeing, the dollar tends to gain strength. Again, another trend that seems to be more common since COVID days. So actually, US market is still huge. I think it will be this year. It's also incredible value if you look at since the referendum to purchase pounds and sell dollars. So those people that have been looking for a few years might be thinking, oh, I'm getting 30% off. And I think that it's going to hold this strength. Trump did want a weaker dollar, but with all the things that he's up to, we're absolutely not seeing that at the moment. But I think continuing going forward, dollar strength and pound undervalued.
What's the comparison of, particularly in the property market, of money coming in to money going out?
There's still, I think, particularly if you focus on London, there's still such a demand for internationals having that London property. I guess it's a bit of a flagship piece that you have to have if you're a particular high net worth. But yes, there are a lot of UK people moving abroad. The easy one is still Middle East, Dubai. We see a lot of flow of funds going over there, probably because it's particularly easy to obtain residency and it's so tax efficient. Now, again, a trend since COVID, we see working conditions so different. People don't need to go to their offices every day. You can work, many industries, you can work from anywhere in the world. So why not try live abroad, potentially better weather and better tax situation.
Is Dubai still the hot favourite for people to go to, or where else is looking good?
Interestingly, the start of this year, Saudi Arabia have, of course, opened up their property market to the world. So whether that, I think it'll be a bit of a slow start for them just because of the infrastructure. Dubai is already so welcoming in terms of the being so easy to move into. Probably Saudi might look a little bit more frightening, let's say, for people that don't know the jurisdiction. Other than that, Europe's still popular. Portugal, Spain, we see a lot of people that are retired expats moving to. Why would you not, with the having 300 days of sun on your back?
So, Will, thank you very much for coming in and doing your 5-minute appraisal of the currency exchange market. Very pleased to have you in the studio. Look forward to having you again next month with your latest comments. I'm Stephen Galpin. Thank you for watching. See you again next time.